Hey guys, let's talk a little bit today about the difference between what a traditional loan assumption is and what purchasing a house subject to is. Because a lot of y'all think that they're one and the same, but I promise you, they're definitely not. In today's video, I'm going to tell you the main difference between the two. So, for case study purposes, let's assume that someone bought a house from a bank. They borrowed X amount of money, but now they've paid it down a little bit and they're down to a $90,000 balance. They have a $90,000 liability to that bank that they're paying off monthly, but they start missing those monthly payments. So what's going to happen? Well, if you stop making your payments, you know what's going to happen. You're going to get foreclosed on. So they may be a few payments behind. Say they owe $93,000 and $94,000 now in back payments and taxes and other things that they've missed on the property, and it's starting to rack up on them. They're in a tough situation. Like most people in foreclosure, they procrastinated, right? Now they're 2 weeks away, they're about to lose the house. So what are they going to do? Well, even if they sold it yesterday, they don't even have enough time for a traditional real estate sale, like a retail sale, to go through and have the bank go through the whole process of creating the loans, etc. They're going to not be able to sell it that way. So what are they going to do? Well, they think in their mind they're going to call up someone like you or me as a real estate investor. We're going to come pay cash. But they owe $93,000, $94,000 on a house that's only worth $100,000, maybe $105,000 tops. Is anybody going to come buy that house? Would you buy that house? I know that I wouldn't buy that house. I sure hope you wouldn't buy that house. So what are they going to do? They're stuck. So traditionally in the past, back in the 70s and 80s, when loan assumptions were the big thing, now I know I wasn't alive then, so I can't really speak on this too much, but people would normally walk up to that seller and say, hey look, why don't I just assume your loan? Why don't I take over your payments, I'll take over your debt, I'll assume that loan, it'll go into my name, it'll go into my company's name, and I'll buy the property from you. And they said great, because the main goal for someone who has a situation that they don't want to be in as far as getting rid of a house is not that they want to get rid of the house. They're not trying to sell the house. They're trying to sell that debt, right? That's why it's hard to get a person to let you take over the house subject to, which we'll talk about in just a second. They want to get rid of that debt. They want to sell that debt. They want to be able to sleep again at night. They want to be able to go about their life and not worry about it. And they definitely don't want a foreclosure on their record. So it worked great for everybody. That buyer didn't have to worry about qualifying for a loan. That seller got the loan out of their name and got the house sold and could go on with their life and not have to go through foreclosure. So it's a great scenario for everyone. Except for who? The banks, right? Why do the banks not like it? Well, they don't want people assuming properties because they're not qualifying for it. They don't want to have to worry about now people who couldn't qualify for a loan having that loan and ending up in the same situation that other seller was, right? Or what about this? Say right now we have relatively low interest rates, 3, 4, 5%. What happens if people lock in a bunch of 30-year loans and in the next 5 years the banks want to up those up to 7, 8, 9, 10%? And then people, instead of going through foreclosure or doing some type of modification or whatever they're going to do, they're just assuming those loans to new buyers that would have had to gone and qualified for a loan at a higher interest rate, right? So the banks don't like it, so that's kind of why they went away. Now, yeah, I know y'all can say that, yeah, there are still assumptions and there's VA assumptions and let's not get off in the weeds too far, but technically the assumptions now today are not like they were back in those wild, wild west days, you could say, because basically now you still have to qualify for that loan. You basically have to go through the same process that you would as if you were just buying a house or refinancing anyway. So it's not the same and it's not that good. So what did we move to? How else can this person get rid of their problem? Well, you could go up to them and say, I'll purchase your house subject to. I have an option for you, right? I can let you sell the house to me and I'll make all those payments going forward. You don't have to worry about it, which is a great option for them. Until they find out what? How many of y'all get this far? They're super excited, they think they have the house sold and they're going to get all their problems, all the problems are going to go away, and then you tell them, but you're going to have to leave that loan in your name. And their face drops, right? Ugh, I don't want to do that. Why would I leave my loan in my name and sell you the house? It makes no sense. And it doesn't really make sense. But if you watch our video that I put out for the 6 ways to find subject to deals, we talk about the scenarios where people are more likely to do this. And one of them is foreclosure. That's why we're using this example. Because what if they don't do this? They're going to go through foreclosure. What if I'm willing to give them $95,000, let them walk with $1,000 in their pocket, save them from atomic bomb on their credit, and from going through a foreclosure, and I make all those payments going forward so they don't have to worry about it. So if I do what I say I'm going to do, I'm going to save them from a foreclosure, let them put a little bit of money in their pocket, and they don't have to worry about making those payments, and I'm going to start making their credit go up because I'm making their payments for them. So it really is a good way to help them, but it's hard to convince someone to let you do that unless they're in a situation kind of where they're dealing with something that's going to help them be motivated to see it your way, as you could say. So the difference between a subject to purchase which is purchasing the house subject to the existing mortgage staying in place. And a loan assumption is just that. When you buy a house subject to, you don't assume that loan. That debt, that liability stays in that first borrower's name. The person that bought the house from the bank, that loan stays in their name. That does not come with the property. You own the property, you're making payments on it, you own it the same way you'd own any rental property, but you don't own the debt. Whereas a loan assumption, you own the debt. That debt is now on your credit, that debt is your risk, that debt is your liability, you're taking over the property and the loan. But you didn't have to qualify for it. So, subject to, you get the property, no loan, but you're making the payments. Loan assumption, you get the property and the debt and the loan goes in your name and you're making the payments. So that's the big difference between the two. Now there's a lot of talk in the community about loan assumptions coming back now. I don't know anybody that knows enough to say one way or the other, but it'd be great if they would. So keep an eye out for that. But guys, if you like this video, go ahead and thumbs up, hit the comment, or put some comments down there. Like it, share it, do whatever you gotta do. Help it get out to help some other people, and I'll see you in the next video. I hope that helps.